Well, I think we're ready. If it's okay with you all, we'll get started. Everyone ready? Good morning. I'm Myron, Frans, Commissioner of Minnesota Management and Budget. I'm joined today to present the economic forecast by Professor Laura Kalambokidis and Budget Director Margaret Kelly. We've provided to you today copies of our one-page forecast summary, copies of the slides that we will be talking about today, and also there are some books available. If anyone's looking for the books online, you can find them at mn.gov/MMB under the tab labeled Forecast and Updates. Let me start with the good news. The forecast balance has increased by $832 million. The available balance for the next biennium is now $1.869 billion. I have pause for smile on my notes. It's my first time, so I'm a little nervous, so I had to write in there to smile. The forecast summary that you see up right here is what we will present and talk about today. The long-term budget outlook in Minnesota remains strong. The story in Minnesota is that we are seeing projected growth in revenues and reductions in projected spending. Professor Kalambokidis will provide details about the improving U.S. economic outlook and the improved GDP growth projections. In particular, she will describe how lower oil prices and the value of the dollar, the rising value of the dollar, affect economic growth. So if we go to the next slide, labeled Higher Revenues, Lower Spending, I want to talk first of all about the current biennium. Relative to the November forecast, this slide shows that we see higher revenues and lower spending projections. And the effect is to show an increase in the balance for the current biennium. The revenue line shows that relative to the November forecast, revenues are projected to increase by $67 million by the end of this biennium, or June 30, 2015. The spending line shows that spending projections decline by $39 million. The combination of these forecast changes increased the ending balance by $105 million. The new balance for the current biennium is $478 million. Many of you will recall that the ending balance in November was $373 million, and that was after we had made a contribution or addition to the reserve of $183 million. Let's go to the next slide, and I'll tell you how this affects the you're already there, the 16-17 budget outlook. This slide shows the effect of the new ending balance for the current biennium, $478 million, added to an improved forecast for the next biennium. The improved forecast from November can be seen in the change column. First, we see an increase in the beginning balance, as I mentioned. Second, we have a $616 million increase in projected revenues for the next biennium. Third, we have a projected decrease in spending of $115 million from the November forecast. These numbers total to an increase of $832 million for the next biennium as a new projected balance of $1.869 billion. I want to point out the budget reserve amount of $1.344 billion. This total includes the cash reserve account and the budget reserve, sometimes referred to collectively as a rainy day fund. In 2014, we increased the reserves by $333 million. First, the budget enacted last year during the legislative session added $150 million to the budget reserve. And last year, we also added a new automatic provision that requires 33% or a third of any balance in November to be automatically added to the reserve. And as you will recall, we added $183 million in November because of that balance. So based upon the addition of $333 million in 2014, we now have a new all-time high reserve of $1.344 billion. There is no automatic addition to the reserve in the February forecast. That only occurs in the November forecast. Today's news is very good news. Over the last few years, we have righted the ship. Please remember that 6 years ago, 4 years ago, and 2 years ago, we were facing large deficits as we began the budget process. And by focusing on balanced budget proposals, we've paid back our schools, We've enhanced strong revenues for the state. We've strategically invested in education. We've carefully managed our state budget. We've increased our reserve. We've implemented strong management ideas like renegotiating health care contracts for the state, saving over $1 billion in that case alone. Minnesota is truly a success story. We have a balanced and diverse economy. We have the 5th lowest unemployment in the country, and we have a growing economy. We now face budget balances for the next 2 biennia. As we plan for this legislative session and the long term, Governor Dayton will review these projections and submit a supplemental budget in March. The governor will be available after this press conference, as you know, for your questions. But now I'd like to turn it over to Professor Kalambokidis to talk about the economic outlook in this forecast.
Thank you, Commissioner. The outlook for U.S. economic growth has improved since we prepared our forecast in November of 2014. Since then, we've learned that the U.S. added 3 million jobs in the past year, the strongest growth since the late 1990s. The U.S. unemployment rate has fallen to 5.7%. That ability to find and retain good jobs, combined with improved household purchasing power, are improving consumer confidence at a national level. And that consumer confidence is buoying consumer spending, which is the largest driver of the change in the U.S. outlook for 2015, for this year. The chart shows the IHS Economics forecast for real GDP growth, and it shows their November forecast and their February forecast, which is the one that informs the revenue forecast you're hearing about today. So the chart shows that the IHS February 2015 baseline calls for annual real GDP growth to pick up from 2.3% in 2013 to 2.4% in 14, the highest annual growth rate since 2010. IHS has slightly increased their overall expectations for growth from 2014 to 19. The largest change, as you can see in the chart, comes early in the forecast, with projected real GDP growth in 2015 increasing from 2.6% last November to 3% in February. IHS now expects 2.7% real GDP growth in 2016 and 2.8% in 2017. So against this backdrop, 2 dramatic developments are shaping the U.S. economic outlook: sharply lower oil prices and a stronger dollar. Sluggish global demand and increased supply, some from the United States, has pushed oil prices down. A barrel of Brent crude oil has fallen by, the price of a barrel of Brent crude oil has fallen by almost a half since last June. Lower prices mean 2 things, among at least 2 things: savings for gasoline consumers, and also for businesses that use petroleum products. So those savings are direct to consumers of retail gasoline, and then indirect through the reduction in the price of petroleum used in products that the consumers buy. But lower oil prices also mean reduced capital investment and potentially drilling exploration by domestic energy producers. But because the United States is a net energy importer, the positive benefits from lower oil prices are likely to outweigh the negative impacts, although those negative impacts will indeed be felt in the energy sector. Meanwhile, the relative strength of the U.S. economy, so the strength of the U.S. economy relative to other national economies, and the potential in the United States for rising interest rates as the Fed moves away from accommodative monetary policy toward more normalized monetary policy, those 2 things are attracting foreign investment and pushing up the value of the U.S. dollar. The trade-weighted dollar is up more than 17% against major trading partners since June. A stronger dollar reduces, the stronger dollar reduces demand for U.S. exports by making American products more expensive relative to imported products. And it increases demand for imported products by making them cheaper. So together, those things increase the trade deficit, the trade balance. Both of the factors, falling energy prices, falling oil prices, and the stronger dollar, put some temporary downward pressure on inflation. So the IHS November outlook that's illustrated here depends on a number of things, including they expect stronger labor market conditions in the United States to translate into improvements in household formations, which improves the housing market or boosts the housing recovery. They also expect stronger labor market conditions to improve labor force growth. They expect productivity growth to rebound to the long-term trend of 2% per year. They expect, and the forecast depends on, the Federal Reserve's actions to move away from accommodative monetary policy to go smoothly. They expect federal fiscal policy not to detract from economic growth, and they expect that international economic and political risk not to be exacerbated from what it is now. So moving to Minnesota's economy, the two developments that are affecting the U.S. economy, low oil prices and the strong dollar, will have an impact here too. A strong dollar will make Minnesota-produced goods and commodities more expensive in Canada, Europe, and elsewhere in the world, possibly, likely, reducing demand for the state's products, including agricultural products, abroad. Regarding low oil prices, some Minnesota businesses have certainly benefited from the oil and gas boom in North Dakota, in neighboring North Dakota, but Minnesota itself is not an oil-producing state. Minnesota's overall economic performance is more a reflection of our fundamental assets, such as a large and diverse economic base, an educated workforce, and a large metropolitan area. So while some firms will see declining opportunities in the Bakken, the net positive effects from the recent decline in crude prices, cheap gasoline for Minnesotans, will likely outweigh the negative impacts on sectors dependent on energy production. So, as the chart says, Minnesota's economic expansion continues. This chart shows the headline unemployment rate for the United States and for Minnesota. Minnesota's the dark line and the U.S. is the lighter line there. Minnesota's labor market firmed up considerably in 2014. The unemployment rate was at 3.6% in December, that's the most recent number, is a full 2 percentage points lower than the U.S. rate. And Minnesota's unemployment rate is the 5th lowest among states. Among large metropolitan areas, the Minneapolis-St. Paul area has the lowest jobless rate of 3.3%. And unemployment rates have fallen over the last 12 months in each of our regional centers as well. So looking at the chart, one thing to note is that the 3.6% where we are now is between the low points of the previous economic expansions, the two previous economic expansions. So in the most recent economic expansion, so on the chart, the vertical gray bars are the U.S. recessions, and so the white spaces are recovery and expansion periods. In the previous expansion in 2002 to 2007, we bottomed out at 3.9%, and we're 0.3 percentage points lower than that with our unemployment rate now. That doesn't mean it can't go lower, because it did. In 1999, it went down to 2.5%. So in addition to the low headline unemployment rate, leading labor market indicators in Minnesota remain strong. The number of Minnesotans filing new claims for unemployment benefits is back to levels not seen since the 1990s. Other indicators, such as average hours worked for private employers, temporary help employment, and job vacancies, are also at levels consistent with a firming labor market. Now, the Minnesota economic forecast depends on the U.S. macroeconomic forecast materializing, but it also depends on its own on these stronger labor market conditions, increasing household formations again to boost housing market, and putting upward pressure on wages. Wage acceleration, along with increased job opportunities, just like at the U.S. level, should draw more potential workers into the labor force. Moving on to talk a little bit more about wage acceleration and wage growth. This chart shows the change in our forecast for wage growth between the November forecast and now. And so we're talking about growth in total wage and salary disbursements in Minnesota. Minnesota nominal wage income grew 3.1% in 2013. Information from the BEA and from, in addition to income tax withholding collections, Minnesota income tax withholding collections, suggests that wage growth rebounded to 4.3% in 2014, and that's stronger than the 3.9% we expected in November. Wage income is now expected to accelerate to 5.4% growth in 2015 and 4.8% in 2016. In November, our forecast similarly called for acceleration, but at different levels than what we're forecasting now. So this wage income growth, especially in 2015, together with increased forecasts for capital gains income and consumer spending, helped to improve the forecast for the next biennium revenues. So the next chart shows the individual income or the change in revenue forecasts by tax type. As you heard from the Commissioner, total general fund revenues for FY 16-17, the next biennium, are now forecast to be $42.497 billion, or $616 million more than the November forecast. And that's adjusted for the January 2015 law changes. Total tax revenues for the biennium are forecast to be $520 million more than the previous estimate, the previous forecast. Higher expected income and sales tax receipts account for nearly all the change in forecast revenues. The individual income tax, as you can see, shows the largest dollar amount of change, $393 million, above the prior estimate. Higher forecast wage growth in 2015 and 16 that I've already mentioned, and higher expected capital gains realizations in 2015 in particular, are primarily responsible for the change. So these changes in tax years 2015 and 16 affect forecast revenues for fiscal years 16 and 17. Sales tax receipts are now forecast to be $124 million more than the November estimate, reflecting increased expectations for growth in taxable sales in Minnesota, including the improved expectations for real consumer spending that I mentioned earlier. The difference between tax revenues and total revenues in the chart is non-tax revenues and other resources, which add $94 million to the revenue forecast relative to November. So typically as we move through a biennium and layer one forecast onto the next forecast, we sometimes talk about how far we are into the biennium and what share of forecast revenue has been collected versus what share is revenue yet to be seen. So how much money is in the bank, so to speak. I think it's useful to remind ourselves now at this point that this forecast for 16-17 is for a biennium that has not yet begun. 29 months remain before the end of the biennium, and a lot will happen between then and now and then. A good illustration of that is the macroeconomic developments that are currently boldly coloring the economic landscape for the United States, which were not anticipated at all as recently as last summer. So I will turn it over to Budget Director Kelly to talk about expenditures.
Thank you. I'm going to speak to the spending side of the story. We are lowering spending estimates in both the current biennium and the next biennium, $39 million for fiscal years 14-15 and $115 million for fiscal years 16 and 17. Beginning with education, our estimates are down slightly in the current biennium, a little bit more in the next biennium, $109 million in 16-17. And these are relative to the November forecast. And these downward adjustments are due primarily to three factors. One is total pupil counts. Included in our forecast for education spending is the number of students who are enrolled in school. And we estimate how many that will be, and we revise that estimate as actuals are reported to the Department of Education. So we are still projecting growth in our pupil count, just lower growth based on actuals reported. Secondly is compensatory aid, which is based in part on students in poverty and the concentration of poverty in our schools. And after many years of increasing poverty concentration, the total poverty counts that have been reported to MDE did not increase year over year last year. And so based on this, we are lowering our forecast moving forward for what the compensatory aid will be, and we've reduced it by $49 million. Special education is the next factor where we see a downward adjustment. Beginning in fiscal year 16-17, we have a new formula for special education funding in our schools. And that formula is based in part on actual expenditures that schools were reporting this year. And the actual data resulted in less expenditures than we had anticipated, and so we are lowering our forecast for special education funding for 16-17 as well. On the property tax aids and credit line, estimates are slightly lower from previous estimates in both biennium, and this change is driven by lower participation than previously anticipated in the homeowner property tax refund program. And this is a continuation of what we saw in November. On the Health and Human Services side, this change is notable in part for its lack of change. Usually we see more change in a February forecast for Medicaid spending. Our November forecast captured data that we typically don't get until this point in the forecast period, and so we saw significant changes in the November forecast. But on the general fund side, we're lowering expenditures in 14-15 primarily due to lower average payments for families and children. We saw this in November. Actual data has come in that is lowering our forecast slightly. General fund expenditures are up in the next biennium, 16-17, and a big part of this change is due to more expensive services being utilized on the chemical dependency side of the equation. On the debt service line, slightly lowering our costs there based on lower assumptions of interest rates, and so our future bond sales will be a little less expensive based on this.
Well, this is our last slide. Let me talk a little bit about it. This is the first time that we've talked about the fiscal year or the biennium of 2018-2019. And we provide this last slide in order to address long-term budget planning into the 2018-2019 biennium. If you add those two numbers together for the difference for 2018-2019, it's $3.184 billion, which is a $1.3 billion increase for the projection of that biennium. Now, as we've already mentioned, the forecast is largely made up of future revenue projections and spending estimates. And we must remember as we look forward into the future that we do not have an enacted budget for the current biennium or for the 2018-2019 biennium. On this slide, we break down the forecast revenues and spending by fiscal year so we can show the structural balance that we are currently forecasting. We know that revenue forecasts include the projected effect of inflation. On the spending side, only some of the spending items include an inflation component. Thus, for purposes of planning, we want to provide a simple estimate of the effects of inflation on spending. But I must point out that adding inflation to an overall spending component is a complex matter. The exercise here is intended to provide policymakers with information on the possible effects of inflation if applied simply to all spending items. Before we all take questions, I just want to end once again on the good news. Minnesota has a positive budget balance for the current biennium, it has a positive budget balance for the next biennium, and it has a positive budget balance for the 2018-2019 biennium. We'll take questions now.
Wages. Last forecast, wages were one of the concerns in the forecast, and now it appears to be the bright spot. Where did this kind of wage growth come from suddenly, and is it as sudden as it appears?
Thanks for the question. So last time I stood here and talked about wages, I probably said the conditions are ripe for wage acceleration. So the labor market in Minnesota had tightened and the unemployment rate was falling, and so we were thinking wages ought to go up. Job vacancies are high. And so at that time, we hadn't seen the evidence that it happened. We still forecast an acceleration, but we hadn't seen the growth that we had expected to materialize. Now we've seen some evidence that may be starting to happen. We know that our estimate of wage growth in 2014 is higher than what we had forecast in November, and so I wouldn't call it a surprise. I would say it's a welcome. It's something we've been waiting for. So it's a guest that was a little late to arrive. And so we're hoping that, well, we're forecasting that it persists.
And persists too, because 2015, the numbers look even better.
Yes.
Why is that?
Why is there a bigger change in the forecast in 2015? If you notice the real GDP graph, chart 2, there's a bump in 2015, and consumer spending is buoyed in 2015. So there are, this seems to be a time when there's some pent-up activity that's expected to occur. So the wage growth that we're forecasting now, we really would have expected sooner. So I think some of that has been pent up. We think we're seeing it happen, and we're forecasting that it persists.
This morning, the fourth quarter national GDP was revised downward from 2.6 to 2.2% growth. Is that reflected all in this? And does that change anything that you're talking about here today?
It's not reflected in this. So what we use to inform our forecast, the macroeconomic forecast we used was the February 2015 baseline from IHS Economics. And so that information was not known at that time. I would point out, though, that while the U.S. growth forecast informs our forecast and sort of sets the stage and helps us understand how the economy is growing, we don't actually tax GDP. And so there's a lot of steps between the U.S. level down to our revenue forecast. But with every forecast, there's new information.
You don't expect that this change, if that had been incorporated in this, you wouldn't have expected a major change in what you're projecting here?
I wouldn't have expected a major change, but I would have to look at the components of that change to know, because some of those individual components matter more to our forecast than others.
The oil price change seems to be a big driver here. Does that mean that we are really vulnerable if oil prices begin to rise rapidly, as they have sometimes in the past?
You're right that the oil price change is an important factor. It's much more of an important factor for states that are net oil producers. And so for them, I think there's some vulnerability. But oil prices are volatile, and so they're used to that if you're an oil producing state. So if our take on this is that primarily the impact on Minnesota is through the consumers and through the lower prices. As prices increase, that's going to affect our consumers. But I wouldn't place us among the states that are particularly vulnerable to changes in oil prices.
Commissioner, the governor has said he wants a bonding bill this session. Can you talk about how this changes the debt capacity and what size of bonding bill is possible?
The governor has indicated an interest in doing an $850 million bonding bill. This new budget forecast provides the resources to do that. And so, although he may change his mind after today's news, but I think at this point, he was going to propose an $850 million bonding bill in March.
How much of the projected surplus is ongoing revenue versus a one-time increase?
Well, the difference between ongoing and current is always a tough question. As we mentioned a little bit earlier, the current biennium, we've adjusted the ending balance for the current biennium by adding $105 million. So the current balance of the biennium is over $400 million. So that is not exactly money in the bank yet, but it's darn close. The truck is on the way to the bank, so to speak. So that money is there. But everything else beyond that for the next biennium, really, they're all future forecasts. We haven't collected that revenue and we haven't spent that money. We don't have budgets enacted to spend that money beyond what we already have under law. So I think it's important. We always try to emphasize this, and I've learned a lot from Professor Kalambokidis about this, and that is to be careful about projections and be careful about what we actually have in the bank and what we actually need to look forward in the future. So the forecast for 2016-17 and for 2018-19, those are all future forecasts for spending and revenue numbers.
The 2014-15 numbers reflect the deficiency bill that was signed into law yesterday.
Yes, they do. Yeah. No, not the deficiency. I thought you meant the tax bill. No, the deficiency has not been reflected.
So we would have to subtract that amount.
Yes, for the budget that will be for this biennium. Yes.
I had a question about household formation and how it's changed since the last forecast. I think I heard that on the national level, household formation is expected to tick upwards because of wage growth.
Yes, and that's our expectation as well. So when we talked about this in November, we were talking about very disappointing household formation numbers at the national level. And the reason it's important, so households form when people who are living together separate and start their living on their own. So it's when young people leave their parents' homes and start a home of their own, or people who have moved in together to save costs during a recession separate. And so it creates demand for housing, and the disappointing levels of household formation last year helped explain the sluggish housing growth last year. We do expect that the improving economic conditions, including improving job growth, job conditions, and improving wages, will increase household formations.
What about some of the other risks? International trade and I believe even agriculture was mentioned. Could you elaborate on that, why those are concerns? Yeah.
Yeah. So both of those are, the international trade is, there are a couple of things happening there. One is geopolitical risk that can happen in very many places and can lead to unexpected changes in demand for U.S. goods. And in addition, sluggish economies among many of our trading partners. So China not growing as fast as it used to, the European community not growing as fast as it used to. Those are risks, and if they are exacerbated, they will reduce demand for U.S. goods and could slow U.S. GDP growth. Added to that is the issue of the strong dollar, which reduces demand for U.S. exports because it makes U.S. exports more expensive relative to imported goods. And so that can be good for consumers of imported goods or people who are traveling abroad, but it leads to some softening of expectations for the kinds of things that are exported, including agricultural exports.
Are there any confidence intervals or anything like that in terms of is this a forecast that's equally likely to go up or down in the future, or I mean, we've got the very firm and specific numbers here. Can you talk about how confident we are in these forecasts and these numbers?
It is a forecast. You're right. So there are risks to it, and there's volatility to the revenue stream. I can't necessarily speak to is it more likely to go up or down, but it could go either up or down. I can't speak to the likelihood on both sides of that. The volatility of the revenue stream means that we need to insure against that risk. And so the budget reserves that we have the target that we have for the budget reserves is based on that revenue volatility and is based on those expectations of just how far off could we be going forward. And so when you're forecasting and there's risk and uncertainty about that, then you insure against that risk with a budget reserve.
No further questions?
How about a little bit more on the short-term versus long-term money? What would be your counsel to lawmakers and their appetite on one-time spending versus spending with tails?
Well, it kind of goes back to the talking about what's in the bank and what's projected. I think one of the things that you always have to be concerned about is when you're, whether you're spending or looking at the budget or adding money to the reserve, you have to look about what does the future hold. And I think one of the things that we're seeing now with the economic forecast that Professor Kalambokidis has described is real strength, a strength in the economy, a strength in the Minnesota economy. So those are a number of different factors you have to look at. But clearly, I think we would exercise caution. That's what we do at MMB, is to exercise caution in budgeting and make sure that the expenditures match with the revenues that we are fairly confident will come in. So it's one of those balancing acts. And one of the things that we've talked about among ourselves is the fact that we need to be careful and manage our expenditures as well as managing the revenues. But this structural balance does provide a look toward the future that we haven't seen in a while. So it's good. It's a good problem to struggle with.
There's some reports that oil prices could jump more than they have in the last 6 years. If that's the case, I guess expanding off of Lori's question, how vulnerable are the projections?
Well, I think the general question of how vulnerable any forecast is vulnerable to any kind of a risk. And so Professor Kalambokidis had a special slide just on risk. And I think that is the key. We're always dealing with a set of parameter of risks that are out there that may or may not happen. Just as that might happen, it might also be that oil stays at a very low rate for a longer time than anticipated. So those are the kinds of things that we have to, the economists have to judge as best they can today, and then tomorrow, things will change. And that's, do you want to add anything, Professor?
I'll add just one quick thing that, to be clear, the macro forecast that we use does forecast prices eventually going up. And so the risk is in how different the reality becomes from what is currently forecast. But they're not forecasting it to stay at currently low levels for forever.
Is there any remaining borrowing that needs to be paid off, or is that all done here?
We have paid off all of the borrowing that needed to be repaid in statute. However, over the years, as we addressed budget deficits, there was borrowing that happened, but statute didn't require it to be paid off. And so all the statutory required shifts and borrowing has been paid off. There's probably still some outstanding.
Could someone explore a little more of these sentences there in the forecast that the state's housing recovery has been disappointing and household formation is unexpectedly slow and the labor force growth remains very weak? That seems, all of those sentences in the forecast seem to contradict what appears to be good news.
So all of those sentences are about how things have been, and we talked already about, you know, when I stood here in November, we were talking about this disappointing household formation number data that had come out. At the time, what it meant, it wasn't good news, but it meant, well, now we have an explanation for why the housing market recovery has slowed down, or why it has been not as strong as we had thought. So now we know it was because of household formations. So those sentences are setting the stage for, it has been, these things have been slowed down. We do expect some pickup going forward. The last one was labor force growth projections. Yeah, so that's not a Minnesota-specific thing. That's a national thing. And so my predecessor, Tom Stinson, and the former state demographer, Tom Gillespie, talked for years about the pending sluggish growth in labor force growth that we should be expecting due to demographic change, the aging of the baby boom. And we're there, and we're seeing it. And so that it's a limiting factor, both for the U.S. economy and for Minnesota's economy. And we expect some incremental improvement in that due to the improvement in the labor force. I'm sorry, in labor market conditions.
To follow up on my last question about borrowing, can you go into any more detail about what remains to be paid and maybe give at least an estimate of what the total dollar amount is?
We don't have a list. But for example, and I'm not sure exactly what years this happened, there were payment shifts that were made in the healthcare area where within a fiscal year of a health plan, we shifted a payment from July to June or from June to July. So that affected our fiscal years but didn't affect theirs, but it made them carry our payments for a month on their books. So there's examples of that. Last session, we actually started paying back a shift of sales tax recognition shift. So not sales tax recognition, but the sales tax, June accelerated sales tax, where we have required businesses to pay sales tax anticipated in July early in June. So last session, we started buying that back and shifted some of those accelerated payments back to, eliminated those. There's still accelerated payments on the books that could be shifted. I'm not sure how much.
Well, there's actually another one coming up that we're taking back, and that's the upfront capital equipment exemption. For many years required companies who purchase capital equipment to purchase it, pay the tax, and file a refund. But beginning on July 1, 2015, we'll implement a new procedure where they'll get that exemption up front. They don't have to pay the tax and file a refund. That's another one of those shifts. So we've gotten a lot of them paid back, but we're still on the hunt for more of them if we can find them.
And then what is the status of the bonding that we did 4 years ago around future tobacco settlement revenues? Is there any plan to accelerate the repayment of those bonds?
I don't believe so. Those
were for the 15-year?
We actually refunded those bonds. Shortly after we sold them, we took advantage of a provision within the bond sale and we refunded them, and so they are now just, it's general obligation debt.
Thank you all very much. Good day.